Welcome to the Deep Dive. We know you want to get smart on what matters fast, without getting bogged down in endless detail.
You're in the right place.
Today, we're diving straight into a huge global shift. The current state of U.S. economic power and the challenges it's facing, real challenges.
Absolutely. And the material you shared with us, it paints a really compelling picture.
Yeah, it shows an American economy transformed over, the last 40 years, driven by huge shifts in trade, global finance.
Oh, great.
So our mission here is simple. Pull out the most crucial insights from these sources about this, let's call it, perceived shift in U.S. economic power, and really try to understand the forces driving it.
By the end of this, you should have a much clearer picture.
Exactly. So let's jump in.
Great. So one of the first things the sources highlight is this really fascinating period, especially after World War II.
Okay.
Where the U.S. Developed this unique ability to consume way more than it actually produced.
How did that happen? It wasn't just luck, was it?
No. It was deeply tied to the dollar being the world's reserve currency, and America's, its geopolitical dominance at the time.
Ah, okay. That makes sense.
Well,
It allowed certain, let's say, economic habits to form.
deeply ingrained habits, yes.
So let's unpack that. The sources point to the 80s and 90s as really pivotal decades.
They were.
Financialization, globalization.
Yeah.
They really took off. And we saw American companies moving production overseas, right?
Massively.
Oh.
Offshoring became the norm.
You couldn't go anywhere without seeing imports of electronics, clothes, toys, tools.
Pretty much everything on the shelves.
And a key part of this, it seems, was that the savings from exporting nations China's mentioned specifically flowed right back into the U.S.
That's a critical point the material makes, this circular flow.
Okay.
Exporting countries built up huge dollar reserves.
Yeah.
And where did they put them? Mostly into American assets, U.S. Treasury bonds mainly.
Right. So that demand for U.S. debt kept our borrowing costs low.
Exactly. Which fueled more consumption, more investment, though maybe not the most productive kind. It wasn't really rooted in boosting domestic production itself.
And the sources call this an illusion of prosperity. That's interesting.
Yeah, it's a powerful phrase.
Yeah.
Because on the surface,
You had full Walmart shelves, low mortgage rates, the stock market was booming, all looked rosy.
visible signs of wealth, absolutely. But underneath, the material points to a real hollowing out.
Stagnant wages for many.
Right. And this wealth effect from rising stocks or house prices sort of papered over some serious structural cracks.
Like the trade deficit. That gap between imports and exports just kept growing. The sources really hammer this point.
They do, and they connect it directly to the loss of manufacturing jobs.
The rise of the Rust Belts.
Precisely. Communities that used to build things became dependent on government transfers, maybe retail jobs, a huge shift.
And this setup, this global arrangement, according to one source, this is exactly what Donald Trump saw as the U.S. being ripped off.
Yes, his perspective, as laid out there, is all about economic re-sovereignization.
Bringing manufacturing back? Tariffs.
Yeah.
He felt the system was unfair to American workers.
That's at the core of it. But, and this is a big but in the sources.
Reversing course isn't easy. Or painless.
Not at all. The material is very clear. Moving from being a net consumer back to a net producer, that's a massive societal shift.
You'd need to consume less, save more.
A lot more. And brace for higher prices, probably higher interest rates, maybe lower stock valuations. It's a fundamental restructuring.
One source uses this analogy, a forced detox, like breaking an addiction to cheap foreign goods.
That's vivid. And it implies withdrawal symptoms, right?
Yeah, companies needing to invest billions in domestic factories, which cost more to run.
Rising labor costs hitting profits?
And consumers getting sticker shock. Plus, the Fed might have to hike rates to fight inflation.
And then there's the impact on asset markets. The sources seem pretty convinced that the era of super cheap money is ending.
Meaning asset prices, real estate, stocks, bonds could fall.
That's the prediction, a significant shift from what we've gotten used to.
And it's not just domestic. There are geopolitical risks too, right? This reliance on others buying our debt.
Huge risk, especially countries like China. If they slow down their treasury purchases or start selling.
Our interest rates could spike,
Yeah.
making our national debt even harder to manage.
Potentially, yes. Exploding debt burdens, it's a vulnerability.
And politically, selling sacrifice is tough.
Extremely tough. How do you convince voters used to cheap stuff and rising 401ks that they need to tighten belts for long-term reindustrialization?
The sources suggest Trump's bet was on nationalism outweighing those economic anxieties.
A big gamble.
So the takeaway here seems to be The old model is broken.
Reached its breaking point, yeah.
Transitioning to production, savings, self-reliance, it's needed, but it'll be bumpy.
Very volatile, and a real test for the political system.
Okay, so that sets the stage. Now, the sources shift focus to something called the Bessent Plan. Who is Bessent, and what was this about?
Right, so Treasury Secretary Bessent, under Trump, apparently proposed this strategy.
Okay.
The idea was basically rebuild trade ties with allies, first the EU, Japan, before confronting China directly.
Sort of a get the gang together approach.
Exactly. Create a unified front of the big Western economies to put more pressure on Beijing.
Makes sense on paper, but the sources seem skeptical. What were the flaws?
Well, the main one, according to the material, is a pretty fundamental assumption.
Which is?
That our allies actually share our exact economic grievances with China, and more importantly, that they're willing to pay the price to confront them.
Ah, so maybe their priorities aren't perfectly aligned with ours?
The sources argue that's a deeply flawed assumption. It's like you need to understand their economic reality, too, not just assume they'll fall in line.
Because trade between the U.S., EU, Japan, it's already pretty open, isn't it? Except for a few sensitive spots.
Exactly. The sources mention things like French farming, American sugar, Japanese rice, politically protected niches. Getting leaders to touch those is hard enough.
Never mind asking them to potentially disrupt their entire economies to follow our lead against China.
Right. And that's the second big problem, the cost to allies.
What kind of cost?
Well, the Bessent Plan, as described, could mean EU and Japanese consumers paying way more for stuff they currently get cheap from China.
Like electronics, car parts?
Pharmaceuticals, machinery. Think about the potential tariffs mentioned, maybe 145% on some Chinese goods.
Yeah.
That could cause a huge spike in their inflation, massive supply chain chaos.
Yeah, why would Germany risk its exports to China? Or Japan, which is so economically intertwined?
Their national interests just don't line up perfectly with that plan. The sources mention Japan's also worried about its own slow growth and aging population.
Makes sense. They have their own problems to deal with.
And here's an interesting twist the sources point out.
Okay.
Amidst all the U.S. trade volatility, the EU and Japan have actually seen some unexpected benefits.
Like what?
A weaker dollar and shaky U.S. markets have sometimes strengthened the euro and yen. That means cheaper imports for them, lower inflation, stable interest rates.
So our actions inadvertently help them in some way.
It seems so. And add to that as China buys fewer U.S. Treasuries.
That money's going elsewhere.
Increasingly into European and Japanese government bonds, apparently, which lowers their borrowing costs. So again, less incentive for them to rock the boat.
Plus, the sources talk about eroding trust in U.S. leadership.
Yeah, that comes up a lot. Pulling out of the Paris Accord, the Iran deal, NATO threats, demands on Japan.
Makes allies hesitant to sign up for long-term plans if they think Washington might just change course again.
Precisely. Consistency is key for alliances.
And this idea of de-dollarization also weakens U.S. leverage, right?
Yes, the slow move away from the dollar, diversifying reserves. It undermines America's financial dominance, making plans that assume that dominance less effective.
And allies are hedging anyway. Europe's building ties with India, Japan, investing in Southeast Asia.
New currency swaps. It signals they want to reduce dependency not just on China, but maybe on the U.S. too. A broader diversification.
So the Bessent Plan sounds like, what do the sources call it? Strategic nostalgia.
Yeah, like looking back to a time when the U.S. could just dictate terms. That world, the sources argue, doesn't really exist anymore.
So confronting China needs more than just demands. It needs a coherent plan, real commitment, and aligned incentives.
Which this approach apparently lacked, potentially leading to the U.S. being more isolated and China, maybe paradoxically, stronger.
Okay, that's a sobering assessment of that plan. Now, the sources shift again to a potential Treasury crisis. What's this about? Sounds serious.
It does. The material points to this quiet but significant trend. Foreign holders of U.S. Treasuries, especially Asian central banks, starting to sell them off.
Selling U.S. government bonds, the things considered the safest asset in the world.
Exactly. And it's not presented as panic selling, more like a calculated shift.
Why? And why is it a crisis?
Well, treasuries are fundamental. They fund U.S. government spending. The whole system relies on steady demand.
Right.
This seller's strike, as one source calls it, seems to be a reaction to a few things.
Like?
The weaponization of the dollar, using sanctions more aggressively, unpredictable trade policies, general political instability.
So countries are getting nervous about holding too many dollars or dollar assets.
That seems to be the implication. China and Japan are named as key sellers. China may be retaliating for trade actions, Japan perhaps needing funds for its own priorities like rearming or economic stimulus.
And the immediate impact. Rising yields on our debt.
Yes, but not because the economy is strong, because trust is weakening, demand is falling. That's the dangerous kind of yield rise.
And the timing is bad. Something about a big debt rollover.
Yeah, the sources mention a huge amount of U.S. debt needing refinancing soon, like April, May. Even a small rise in borrowing costs could add billions, maybe trillions over time to the deficit.
Wow. And we already have, what, $34 trillion in debt and a big deficit.
Exactly. Not much wiggle room. And the Fed might be hesitant to just print money, quantitative easing, because that could spook markets even more about inflation.
It sounds like a potential fiscal nightmare.
The sources certainly paint a picture of a very delicate situation, highly interconnected, makes you think if different choices earlier could have avoided this.
So markets are noticing. More volatility, weaker dollar, stocks shaky.
Reflecting investor nerves, yes. Jitters about fiscal sustainability, the end of the cheap money era.
And this ties back to the unpredictable policies. Tariffs, threats against Chinese firms.
Contributing to a perception, rightly or wrongly, of the U.S. as an unreliable steward of the global economy, which makes big investors cautious.
And it's happening as the dollar's global role is already shrinking a bit.
Right. The declining share in reserves, diversification into euros, yen, gold, even China's digital currency. It all feeds into this trend.
Less demand for treasuries.
And strategically, when China or others buy, say, European or Japanese bonds instead,
it helps their currencies and lowers their borrowing costs.
While the U.S. faces the opposite. A weaker dollar, higher rates, it's a significant capital shift.
There's a real irony here. The trade war aimed at China
ends up triggering this financial pushback through bond sales, a kind of bloodless rebellion, as one source puts it.
And Bessent's plan to calm markets via allies might be sunk by the bond market itself.
That's the tension. Refinancing needs versus geopolitical goals. The sources argue this crisis was foreseeable. Warnings about relying on foreign money were ignored for short-term benefits.
So this treasury issue is like a mirror, reflecting deeper problems.
Deeper dysfunctions, yeah. The era of easy money and unchallenged dominance might really be over without some bold changes.
Okay, shifting gears again, the sources bring in India. Why India, suddenly?
Well, India emerges in this narrative as a really interesting player, almost an unexpected winner from all this U.S.-China tension and global reshuffling.
I saw.
Under Modi, India is portrayed as playing a smart game. Strategic patience, economic reforms, kind of geopolitical opportunism.
Keeping ties with both Washington and Beijing.
While opening up its own markets and strengthening ties elsewhere, like the global south.
So India becomes appealing to both sides.
That's the idea. The U.S. needs an alternative to China for manufacturing, democratic, young population, English speakers, huge market.
Ticks a lot of boxes.
And China needs India, too, as a market, maybe for labor, for regional stability.
So India's in the catbird seat, strategically.
Pretty much. And the sources point to the Make in India initiative having real success.
Attracting manufacturers who want to diversify away from China.
Yeah, big names are mentioned. Apple, Samsung, pharma companies, even semiconductor firms looking at India as a parallel production base.
And India's signing new trade deals, too.
Actively. FTAs with the UAE, Australia, talks ongoing with the UK, EU. It shows Western eagerness to tap into the Indian market. They're seen as strategic endorsements.
It sounds like a rare moment where lots of different global players see India as important for their own reasons.
Exactly. US sees a hedge against China. China needs stability. EU wants diversification. Russia needs trade partners. India is, as one source says, everyone's plan B.
And that means opportunities flooding in. FDI, tech, manufacturing.
Huge opportunities. Surging investment in manufacturing, fintech, e-commerce, defense, clean energy. Global VCs are interested. Trade is growing with the US, UAE, Europe. That $5 trillion economy goal seems more plausible.
And its geopolitical influence is growing too. G20, BRICS, the Quad.
Increased visibility everywhere. Naval diplomacy, vaccine diplomacy, climate talks. India's definitely stepping up.
So it's not all smooth sailing, right? The sources mention challenges.
Oh, absolutely. Complacency is a risk. Infrastructure still needs work. Complex labor laws, bureaucracy, execution gaps.
And the geopolitical balancing act must be tricky. Pressure from the U.S., pressure from China.
Very tricky. Leaning too far west could invite Chinese retaliation. Leaning too far east raises U.S. concerns. Maintaining that strategic autonomy is key.
Financial risks, too. All that capital flowing in could cause overheating.
Potential for overheating, yes. Or capital flight if things wobble. Balancing openness with sovereignty.
And domestic stability is crucial for investors.
Absolutely. Social cohesion, political pluralism, reliable institutions. These things matter hugely for long-term confidence.
But the overall picture is, this is India's moment.
A major opportunity to become a key anchor in a new global order if they manage it well. Requires sustained reform, inclusive growth.
Okay, now let's circle back to the dollar. The sources talk about the decline of dollar exceptionalism. We touched on this, but they seem to go deeper.
They do. They start by acknowledging the dollar's long reign, reserve currency, backbone of global finance, giving the U.S. unique privileges.
The exorbitant privilege, as it's sometimes called.
Right, but they argue this era is ending, or at least significantly changing.
And the trigger, again, policy choices.
Policy arrogance and chaotic execution are phrases used. Weaponizing the dollar through sanctions, Trump's tariffs, unilateral pressure, it's made others nervous.
And led to that seller's strike we discussed. Asian central banks quietly shifting away from treasuries.
Exactly. That's framed as the key inflection point. Moving into gold, euros, yen, regional currencies, China's digital yuan.
Because holding dollars, or treasuries, now carries political risk. It's not seen as purely safe anymore.
That's the argument. If the U.S. can freeze assets or impose sanctions easily, holding large amounts becomes less appealing.
And the consequences. Softer demand for treasuries means higher U.S. borrowing costs.
Higher interest rates across the board eventually. Makes debt finance consumption less affordable for everyone.
And weakens the Fed's toolkit. QE becomes riskier if the dollar isn't seen as totally solid.
It could risk currency collapse in a worst-case scenario. Yeah, the old playbook might not work as well.
Plus, the threat of financial sanctions loses its punch if countries have alternatives.
Exactly. Russia moving reserves, Iran and Venezuela using barter or crypto, the EU setting up its own payment channel. Countries are building parallel systems.
So the perception shifts. The dollar looks more like a political weapon.
Which accelerates multipolarity. Countries hedge their bets, demand more say in global institutions.
And U.S. actions, like the trade war tariffs, backfired.
In this sense, yes. Opponents like China retaliated financially. Allies like Japan maybe took revenge by selling bonds. The EU pursued its own path. The bluff was called, in a way.
So it's not a dollar collapse overnight.
No, more like a gradual decline. Diversification, like the British pound's decline historically.
But it forces the U.S. to face facts. Need to produce more, consume less, save more, fix the budget.
Confront those structural weaknesses, yes. Because the world won't just finance U.S. deficits indefinitely on the same terms.
And politically, that's painful. End of cheap imports, maybe asset booms, could mean inflation, austerity.
Strain on the social contract, definitely. But the sources also see an opportunity in the crisis.
A chance to refocus on productive growth, maybe more strategic humility.
Democratic resilience, yeah. A potential renewal. But the immediate effect of the trade war strategy, according to this analysis, was destabilizing American power.
Leading to the end of financial unipolarity. A multipolar world economy requiring the U.S. to adapt.
That's the core message. The U.S. no longer stands alone financially.
Okay, brings us towards the end. The sources discuss Stephen Miran's playbook. Who is Miran and what's his plan?
So Stephen Miran is presented as an economic advisor proposing a way forward, focusing on Washington's own fiscal and monetary tools to stabilize things after the trade war disruption.
Like what? What's the Fed's role in his plan?
Controlled bond buying, not full-on QE again, but targeted temporary purchases of long-duration treasuries.
Why?
To provide liquidity, calm markets, especially during that big debt rollover period like Q2 2025. Basically, prevent a seller strike without causing an inflation panic. The Fed as a geopolitical tool itself.
So, a surgical intervention by the Fed to keep borrowing costs manageable and maintain stability.
That's the idea, a backstop.
And he also proposes a 100-year bond. That sounds unusual.
It is, but the rationale is to fund the massive long-term costs of decoupling and reshoring.
Like building new chip factories, securing rare earths, investing in AI, things that take decades.
Exactly. Lock in funding now, spread the cost over generations. Like financing a war or a major infrastructure. The idea is pension funds, insurance companies, sovereign wealth funds might buy them for the long duration.
So change the debt conversation from short-term crisis to long-term strategic investment.
That seems to be the goal.
And the third piece is ally shoring. What's that?
It's about deliberately moving supply chains, but not just anywhere cheap specifically to trusted allies.
India, Vietnam, Mexico, maybe Poland, Taiwan.
Places like that. Focusing on political reliability and resilience, not just low wages. Semiconductors, batteries, critical minerals from places like Chile or Australia.
And the U.S. government helps facilitate this.
Yeah, using agencies like the Development Finance Corporation, Exim Bank, new trade deals to co-finance these new industrial ecosystems with allies, create a kind of tech-industrial counterbelt and road.
So Miran's playbook is about merging financial market stabilization, long-term industrial planning, and strategic diplomacy.
Pretty much. A new kind of economic statecraft for a multipolar world, moving from fragility to consolidation. Crucial for big tech, crucial for U.S. leadership.
Okay, so wrapping this all up, it seems the initial goal of the trade war, resetting trade, kind of morphed into this much bigger systemic disruption.
Accelerated trends that were already there, maybe? Push things towards multipolarity faster?
And exposed the roots of the issue. America's reliance on debt, on foreign capital, especially from Asia, to fund consumption, while the industrial base weakened.
Decades in the making.
Trump's policies then acted as a catalyst, triggering unexpected backlash, like China and Japan selling bonds, the EU stepping up.
And that global seller strike a reaction to weaponizing the dollar, politicizing trade, pushing countries to hedge against the dollar more actively, local currencies, swaps, gold, parallel systems.
With really profound consequences for the U.S. economy. Higher rates, bigger deficit, inflation, nervous markets, the Fed in a tough spot.
While players like India emerge as pivotal, benefiting from non-alignment, courted by everyone.
And it forces a kind of moral reckoning, too. The U.S. using protectionism, China setting rules for the global south, the EU flexing its muscles. Influence is shared, contested now.
Leading to a more volatile world. Faster capital flows, harder coordination, questions about global institutions and safety nets.
So it's a moment for U.S. introspection. The trade war exposed vulnerabilities, highlighted the need for reindustrialization, fiscal discipline, rebuilding trust.
Coercion isn't credibility, as the sources seem to imply.
Though, maybe, ironically, Trump's gamble succeeded in one way. By forcing this reckoning, stripping away illusions about dollar hegemony.
That's a possible interpretation presented. It forced uncomfortable questions to the surface.
The fundamental lesson being, global leadership needs to be earned. Consistency, reform, cooperation. You can't just assume dominance anymore.
Exactly.
And the final thought the sources leave us with is pretty provocative. As the world shifts away from being U.S.-centric, the end of this trade strategy marks the end of a whole paradigm. What does that mean for us? For stability, for opportunity?
Yeah, and specifically, this pivot the U.S. might be attempting from consumption to manufacturing that's going to involve real pain. Can the U.S. system and its people actually sustain that? How will the world react? That's the multi-trillion-dollar question for the coming decades.
The global order is definitely churning, maybe heading for a reset, the fourth turning, as some might say.
It certainly feels like a moment of profound change.
A really fascinating and, yeah, sometimes sobering deep dive today. Thanks for walking us through this material.
My pleasure. Lots to think about.
Definitely. Thank you for joining us on the deep dive.